This is an industry that's been in fierce defense of itself. Blue Owl being one of those ones, really vocally coming out and saying, you're wrong, Jamie Dimon. They're not cockroaches. Things aren't wrong. You maybe side a little bit more with Jamie Dimon in this argument.
We're living in a world where it's truly a K-shaped world. So tech, data centers, financing them, building them, going out and where these valuations are, that is a very hot market. There's a whole other piece of the industry, the bottom part of the K. So when we think about it, chemicals, in just an extraordinary down cycle, anything associated with autos and construction and manufacturing. Manufacturing has been 8 months of negative numbers in US manufacturing for the last 9 months, right? So when you look at that world, and forget even cockroaches or otherwise, right? When you look at the fact that I think the point I'd like to make more is we're living truly in a K-shaped economy, and what is happening in that lower part of the K, actually focusing on figuring out solutions around it is probably one place where there should be a lot more focus.
Right, not enough light there because we're all looking at the spotlight on the data center build out, right?
Yeah.
Are we seeing, do you think, a recession in a big piece of the economy?
Parts of it are recessionary. You know, when you have 9 months of PMI numbers, producer manufacturing numbers, negative in the United States, that tells you manufacturing is recessionary today, last 9 months, right? But I don't think it's so much even, I happen to think, please, I'm not an alarmist. I don't think there is some crash coming, there's some huge recession coming or something. That's not our base case. But in a world where you have so much of the leveraged credit market, which is in those deals where, and these are deals done pre-2022, interest rates are so much higher. The earning numbers are flat to down in some of these businesses. I think the focus on trying to fix it, how much capital needs to go in there to kind of fix it, right? And how do you kind of solve some of these issues? I think that's where, Matt, I think you've got to put light on.
Victor, can I just ask, because manufacturing, one of the key goals of this administration, I've talked to Scott Bessent about it, and obviously Donald Trump wants to bring manufacturing back to America. That's the point of his, at least partially, the point of his tariff regime. Is the administration helping this situation if manufacturing is in a recession? I mean, they've been here for a year. Are they doing the right thing?
No, they've started. They're trying. It takes a while to turn around these aircraft carriers.
Right.
It doesn't kind of happen quite like that.
So with the one big beautiful bill, you think that's going to add some stimulus, some impetus to this?
It's a down payment.
Yeah.
Right?
And you know these really well because this is part of what SVP does so well. You look at this stress and you find ways to put capital to work, to make it look better. But this is an industry, Matt and I have had so many private credit conversations where managers will come in here and they say, we're investing in the new economy. We're in that up part of the market. We're doing really well. Do you think that this is an industry that either hasn't fully grappled with or just isn't admitting what things really look like underneath the surface?
Look, everybody loves to talk their own book, okay? So who am I to kind of cast stones at anybody, right? But what we would tell you is, after you had First Brands happen 2 months ago, we've always had a relatively high level of defaults in high yield. If you look at Moody's statistics, they tell you default rates are 5%, 5.5%. That's 1 out of 20 companies, right? That's a high level of defaults. But something else happened starting about 2 months ago. 2 months ago, after First Brands, there are 15 deals we are tracking with debt greater than $2 billion, some of them with $20 billion of debt in the high yield universe, and the senior debt is now trading at prices under 70 cents. Right? So I think there's whatever you saw happening there, We did, as a group of investors, we all made investments pre-2022 when interest rates were zero. Interest rates are higher. Some of these underlying businesses are sluggish. And as a result of that, some of these capital structures need to truly get fixed. Under 70 cent senior debt means the company is essentially a zombie company for right now, right? And we've got to kind of start to attack it. And that, by the way, I think, as you know, that's our focus. We provide capital. Look, some of these will end up as restructurings, sure. But at the same time, so many of these great businesses, some of these are really great businesses, just over-levered. They need capital they need preferred capital, junior capital to go out and kind of restructure that balance sheet, right? So to our way of thinking, there's just a whole bunch more opportunity.
I was saying First Brands isn't a one-off, is also what you're saying.
It is. To talk about fraud, to talk about something, all the different...
Because that's what most people say. It's fraud, it's idiosyncratic, there's no other cases of it.
But also that it's a great business, right? Bruce Richards was sitting right where you are, and he said it's a great business. And I buy First Brands products for my cars, Can
I tell you, I'm not going to debate First Brands' great business or bad business.
Yeah.
The balance sheet obviously was a little exaggerated, if I'm just being polite, right?
And the super senior debt is trading at what, 60 cents?
I think 50 now.
Yeah. But you're on top of it as I am.
So you're involved in First Brands, if I'm not mistaken.
We are now, and I have to just be very careful about it for that reason. But put First Brands on the side. The 15 companies whose debt has fallen between $2 billion and even $20 billion in the last 2 months, we don't think there's fraud here. They're just over-levered. Just way over-levered, and these deals done pre-2022. And I think that's the part we've got to kind of work through and fix. For manufacturing to really get better in the US, you've got to fix these zombie capital structures, the ones which we've created.
And for you, it's an opportunity, right? As we've discussed, when you see good companies that just need more finance in there, regulators might look at it differently. And there's been a lot of attention in Washington, D.C. Elizabeth Warren and another Democratic representative have been talking that credit needs to be stress tests like the banks. FDIC changing rules on leveraged loans that make things more friendly to the banks. Do you think the tide is really changing, where regulation is now focusing on alternative lenders versus the banks?
The alternative lenders have had a free ride, right? The banks they used to compete with had one arm tied behind their back, and the private credit guys were able to kind of, to me, from a distance, we are not in the direct lending business, okay?
Right.
So I'm a little distant from it, but you can see now the banks which had one of their arms tied behind their back, that arm's being freed up, right? So there's a little bit more competition than there was.
But when there's more competition, often that leads to standards that get a little bit looser, trying to win over that. That sounds like maybe not the healthiest thing, actually, to have that competition back.
Yeah, in credit, we have cycles, Danny. We're going to have a little cycle.
Where are we? Where are we right now in the cycle?
Spreads are close to record tights when you look back over 20 years. They've been right around kind of 300 odd basis points, give and take, right? Give or take. Those are really, really tight spreads, just in terms of where we are. So look, we're poised. You just look at high yield over time. Spreads can blow out to 600, 800, 900 over. And that's sort of what happens when in a recession. I don't think we're in a recession in the next year or two. Don't get the wrong idea.
Right.
But please, I think our view would be you're lending today with really tight spreads. The amount of new issuance which is coming into the high yield market, all this data center stuff you're hearing about, well, guess what? The hyperscalers are coming to borrow in the high yield. The amount of supply is just going to increase a lot. I think, to our point of view, the pressure on spreads is likely to go up, even barring a recession. The pressure on spreads to clean up all the stuff I was describing, all that just requires capital, and those spreads they will have to kind of widen to accommodate it.
Victor, can I just ask, not in the direct lending business, but you're a pioneer in the distressed credit business, and Howard Marks is another who was just on surveillance. He said he thinks that these are healthy markets, healthier than they were in 2000, but that the Fed shouldn't be necessarily moving rates much more at this point. What's your view on what the Fed should be doing?
Yeah, beyond my pay grade.
It is not. If anyone gets paid enough to talk about this, it's you.
Look, you're hearing me describe some real caution.
Yeah.
Right? So in kind of a cautious market like this, where inflation isn't quite licked, I think caution would suggest just go easy. Don't supply more fuel to that fire, right? But I'm a little bit of an old-fashioned, I'm a little more cautious.